Welcome to our comprehensive exploration of bank runs and their pivotal role in economic crises. Today, we embark on a journey to understand this critical phenomenon. A bank run occurs when a large number of customers withdraw their deposits, fearing the bank's inability to fulfill its obligations. This mass withdrawal can lead to severe liquidity issues, causing the bank to collapse. Bank runs have historically been harbingers of economic turmoil, often accelerating or even triggering financial crises. These events remind us of the fragile balance within our banking systems. In this video, we delve into the causes and effects of bank runs, examining historical and modern examples to paint a vivid picture of their devastating impact. We'll analyze key moments in economic history, such as the Great Depression and the 2008 financial crisis, to illustrate how bank runs can unravel financial stability. Join us as we uncover the lessons learned from past bank runs and highlight the importance of financial stability in safeguarding our economy. Welcome to our deep dive into the world of bank runs and their profound impact on economic crises. A bank run occurs when a large number of customers withdraw their deposits simultaneously, driven by fears of the bank's insolvency. When trust in a bank's stability erodes, panic spreads swiftly. Individuals rush to secure their funds before the bank runs out of cash. Imagine, for a moment, that you've saved your hard-earned money in a bank, only to wake up one day to rumors of its financial troubles. Anxiety mounts and queues form at the bank's doors. The once secure institution is now on the brink of collapse. The mechanics of a bank run are rooted in the fragility of confidence. As more customers withdraw their money, the bank's reserves deplete rapidly. Unable to meet all withdrawal demands, the bank faces insolvency, which can trigger further panic and more withdrawals. This vicious cycle can lead to widespread financial instability. Let's see how history has been shaped by such events and what we can learn to prevent them. During the Great Depression, bank runs became a pervasive and alarming reality. In a panic, thousands of depositors rushed to withdraw their money, driven by fears of impending insolvency. This collective frenzy fueled a vicious cycle of bank failures, loss of savings, and economic downturns. Businesses shuttered, unemployment soared, and the financial system teetered on the brink of collapse. This historical episode vividly demonstrates the destructive power of bank runs. It underscores how quickly fear can escalate into economic turmoil, leaving profound scars on the financial landscape. As we move forward, you'll see how factors leading to such events unveil themselves and how history continually warns us to seek stability in our financial systems. Bank runs can be triggered by a variety of factors, each playing a significant role in destabilizing financial systems. Economic instability is often a primary cause, where deteriorating economic conditions lead depositors to fear that banks may become insolvent. Psychological factors, such as rumors and speculation, can spread quickly and incite panic among the public. Even a baseless rumor about a bank's financial health can prompt a wave of withdrawals, creating a self-fulfilling prophecy. Loss of confidence in the banking system due to past failures or perceived mismanagement also fuels bank runs. Understanding these triggers is essential as it highlights the delicate balance required to maintain financial stability. Next, we will explore the immediate and long-term economic impacts of bank runs, shedding light on the far-reaching consequences they have on the wider economy. When a bank run begins, its immediate effects are felt quickly and can be devastating. Imagine waking up to learn that your bank is insolvent, and your life savings have vanished. This scenario has played out repeatedly during financial crises, causing individuals immense hardship. Banks, unable to meet the sudden surge of withdrawals, quickly become insolvent. Long-term, the impacts are just as severe. Entire economies can spiral into recession. Businesses can't secure loans, leading to layoffs and cutbacks. Consumer confidence plummets, reducing spending and investment. The repercussions ripple through the economy, potentially causing a full-blown economic crisis. Historically, bank runs have paved the way for profound economic downturns. The fear of losing deposits fuels a self-fulfilling prophecy, where the rush to withdraw actually causes the failure that's feared. Recognizing the immediate fallout and long-term consequences is crucial for understanding why preventing bank runs is so vital. The 2008 financial crisis remains a stark reminder of the fragility of our global financial system. At the heart of it were several high-profile bank runs that shook the very foundations of the economy. During this period, the fear of insolvency led to a massive withdrawal of funds, draining liquidity and causing panic among investors and the general public. Banks, unable to meet withdrawal demands, faced collapse, prompting government bailouts on an unprecedented scale. The financial tremors from these bank runs cascaded across the globe, plunging economies into severe recessions, skyrocketing unemployment rates, and leaving millions without jobs or homes. Understanding modern examples helps grasp the vital importance of financial stability. We'll uncover the measures taken to prevent such crises and the roles regulatory bodies play in maintaining economic equilibrium. Stay with us as we delve deeper into preventing bank runs and the vital function of central banks in our next segment. To prevent bank runs, regulatory measures and banking reforms play a crucial role. Governments and financial institutions must work together to establish frameworks that promote stability and confidence. Regulatory measures, such as deposit insurance, ensure that depositors' funds are protected, reducing the panic that often leads to bank runs. Additionally, tighter banking regulations can help prevent risky behaviors that might compromise a bank's solvency. Introducing stress tests, regular audits, and transparent reporting can foster a robust banking environment. Public confidence is paramount. Clear communication from banks and government authorities about the health and stability of the financial system can mitigate fears and prevent mass withdrawals. Ultimately, these measures aim to create a resilient financial system that can withstand economic shocks. Let's explore how central banks play a key role in this stability. Central banks stand as pillars of stability in the financial sector, crucial in both preventing and managing bank runs. By swiftly providing liquidity, they ensure that banks can meet the sudden surge in withdrawal demands, calming the storm before it turns into a crisis. This intervention not only prevents banks from collapsing but also instills confidence among depositors, halting the fear-driven frenzy that ignites bank runs in the first place. Beyond immediate crisis management, central banks play a long-term role in maintaining financial stability through vigilant oversight and strategic monetary policies. They monitor financial institutions closely, ready to act at the first signs of instability. Through these actions, central banks act as guardians of the economy, ensuring it remains robust, resilient, and resistant to the shocks that could otherwise lead to widespread economic downturns. As we draw to the close of our exploration, it's vital to reflect on the key lessons learned from both historical and modern bank runs. These events have repeatedly underscored the critical importance of maintaining financial stability. From the Great Depression to the 2008 financial crisis, we've seen how the collapse of public confidence can trigger widespread bank failures, leading to economic turmoil. One of the most crucial takeaways is the need for effective regulatory measures. Regulatory frameworks must be robust and adaptive to safeguard against the triggers of bank runs, ensuring that banks remain solvent even amid uncertainty. Moreover, the role of central banks in providing liquidity and stability cannot be understated. Their timely interventions often prevent panic from spiraling into full-blown economic crises. Moving forward, let's recognize that financial stability is not just a goal but a necessary foundation for economic prosperity. In conclusion, understanding the phenomenon of bank runs and their profound impact on economic crises is essential. We have explored their causes, effects, and both historical and modern examples, from the Great Depression to the 2008 financial meltdown. These insights reveal the fragility of our financial systems and the critical need for regulatory measures and banking reforms. Central banks play an indispensable role in maintaining financial stability, and their interventions can prevent the chaos caused by bank runs. As we wrap this up, remember the importance of staying informed and proactive. Educate yourself about financial systems, support policies that promote stability, and remain vigilant to signs of economic distress. Financial stability is not just a concern for governments and banks, it's a responsibility we all share. For further learning, continue exploring resources on economics and finance. Together, we can build a more secure financial future. Thank you for watching, and don't forget to subscribe for more insightful content.